Cap this, cap that, that's cap. What is this cap rate thing that commercial brokers are always marketing their properties for sale with? What's up, hungry investors? Welcome back to the channel. Ever wondered how savvy commercial real estate investors spot a diamond in the rough? It's not just about luck or intuition. It's about understanding the numbers. Today, we're diving deep into one of the most fundamental metrics in commercial real estate, the capitalization rate, or cap rate as it's more widely referred to. In this video, we'll break down how cap rates work, the factors that influence them, and how to use them to your advantage. Are you ready to feed your appetite for investing? Stick around to learn more. Cap rates are like a financial crystal ball, giving investors a glimpse into a property's potential returns. But how does it work? Think of cap rate as a ratio. It compares a property's net operating income, or NOI, to its purchase price. So the higher the NOI relative to the price, the higher the cap rate. But remember, cap rates aren't created equal. Factors like location, property type, and market conditions can all significantly influence them. A prime location might have a lower cap rate due to a higher demand, while a property in a less desirable area might have a higher cap rate to compensate for the risk. Now, let's talk about how investors use cap rates. Some focus on properties with higher cap rates, hoping to find undervalued opportunities. These have higher risk, but present the opportunity for higher reward, as in higher returns. Other investors prefer low cap rates, betting on properties that will appreciate in value over time, or that have more stable tenants with better credit and solid business operations. These have lower risk, but present the opportunity for a stable and predictable cash flow or income stream. They still have higher returns than other alternative investment options, but allow for a regular cash flow payment and are what we call a coupon clipper. But remember, cap rates are just one piece of the puzzle. It's essential that you consider other factors like market trends, tenant quality, and property conditions. For instance, a property with a high cap rate might seem attractive at first glance, but if the market is in decline or the tenant is unreliable, the investment could be a risk not worth taking. That's why it's crucial to do your due diligence and consider the overall picture. On the other hand, a property with a low cap rate might seem less appealing, but if it's in a prime location with a strong tenant base, it could be a solid investment. The key is to balance the cap rate with other factors and make an informed decision. So how can you use cap rates to make better investment decisions? Here's a few tips. 1. Compare cap rates to market averages. This will give you a sense of whether a property is overvalued or undervalued. 2. Consider the property's risk profile. Higher cap rates often indicate higher risk, so be sure to assess the potential risks and rewards. 3. Look beyond the numbers. Don't solely rely on cap rates. Consider other factors like property condition, tenant quality, and market trends. By following these guidelines and understanding the intricacies of cap rates, you can make more informed real estate investment decisions. Remember, cap rates are a powerful tool, but they're not a magic bullet. Use them wisely, and you'll be well on your way to building a successful real estate portfolio. Join the conversation. Leave a comment below with your thoughts on how you can now better understand commercial real estate investment value using cap rates. Thanks for joining me and watching this video today. If you enjoyed this video, don't forget to like and subscribe for more commercial real estate insights and information. See you next time, and as always, stay hungry, my friends.